11. Selling and distribution cost budget. Selling and distribution are indispensable aspects of the profit-earning function. Selling cost is defined as the cost of seeking to create and stimulate demand and of securing orders. While making a budget, selling costs are divided into fixed and variable. Semi-variable costs should also be separated into variable and fixed elements. Distribution cost has been defined as the cost of the sequence of operations which begins with making the packet of product available for dispatch and ends with making the reconditioned return of empty package, if any available for reuse. Preparation of the advertising cost budget is the responsibility of the sales manager or advertisement manager. Selling and distribution are indispensable aspects of the profit-earning function. 12. Administrative expenses budget. The administrative expenses are mostly policy costs and are, therefore, fixed in nature. The most practical method to follow in preparing estimate of these expenses is to follow the past experience with due regard to anticipated changes either in general policy or the volume of business. 13. Research and development expense budget. Research is required in order to develop and/or improve products and methods. The following are the methods of allocation of R&D expenses. 1. A percentage based on total sales value. This method is good if sales value is steady from year to year. 2. A percentage based on net profit. 3. A total sum is estimated on the basis of past experience and future R&D plans and policies. 4. A sum is fixed on the basis of cash resources available with the company. 14. Capital expenditure budget. The capital expenditure budget represents the planned outlay on fixed assets like land, building, plant, and machinery, etc. during the budget period. The preparation of this budget is based on the following considerations. 1. Overhead on production facilities of certain departments as indicated by the plant utilization budget. 2. Future development plans to increase output by expansion of plant facilities. 3. Replacement requests from the concerned departments. 4. Factors like sales potential to absorb the increased output, possibility of price reductions, increased costs of advertising and sales promotion to absorb increased output, etc. Merits of capital expenditure budget. 1. It outlines the capital development program and estimated capital expenditure during the budget period. 2. It enables the company to establish a system of priorities. When there is a shortage of funds, capital rationing becomes necessary. 3. It serves as a tool for controlling expenditure. 4. It provides the amount of expenditure to be incorporated in the future budget summaries for calculation of estimated return on capital employed. 5. This enables the cash budget to be completed. With other cash commitments, capital expenditure commitment should also be considered for the completion of the budget. 6. It facilitates cost reduction program, particularly when modernization and renovation is covered by this budget. 15. Cash budget. It is the plan of receipts and payments of cash for the budget period, analyzed to show the monthly flow of cash drawn up in such a way that the balance can be forecasted at regular intervals. The cash budget's one of the most important elements of the budgeted balance sheet. In addition, the capital expenditures budget, dividend policies, and plans for equity or long-term debt financing also affect the cash budget. Master budget consists of budgeted profit and loss account and budgeted balance sheet. It represents a standard for the achievement of which all the departments will work. On the basis of the various budgets prepared, we prepare below budgeted income statement and budgeted balance sheet. Period-wise budgeting. Long-term budget. The period of long-term budgets varies between 3 to 10 years. These budgets are useful for those industries where gestation period is long. Short-term budget. Generally for 1 or 2 years and are in the form of monetary terms. Current budgets. The period of current budgets is generally of months and weeks. These budgets relate to the current activities of the business. Zero-based budgeting, ZBB. A method of budgeting which requires each cost element to be specifically justified, although the activities to which the budget relates are being undertaken for the first time. Without approval, the budget allowance is zero. ZBB is an activity-based budgeting system. ZBB is suitable for both corporate and non-corporate entities. Stages in zero-based budgeting. Identification and description of decision packages. Evaluation of decision packages. Ranking, prioritization, of the decision packages. Allocation of resources. Advantages of zero-based budgeting. The advantages of zero-based budgeting are as follows. 1. It provides a systematic approach for the evaluation of different activities and rank them in order of preference for the allocation of scarce resources. 2. It ensures that the various functions undertaken by the organization are critical for the achievement of its objectives and are being performed in the best possible way. 3. It provides an opportunity to the management to allocate resources for various activities only after having a thorough cost-benefit analysis. The chances of arbitrary cuts and enhancement are thus avoided. 4. The areas of wasteful expenditure can be easily identified and eliminated. 5. Departmental budgets are closely linked with corporation objectives. 6. The technique can also be used for the introduction and implementation of the system of management by objective. Thus, it can not only be used for fulfillment of the objectives of traditional budgeting, but it can also be used for a variety of other purposes. Why zero-based budgeting is superior to traditional budgeting. Zero-based budgeting is superior to traditional budgeting in the following manner. 1. It helps in the introduction of a system of management by objectives. 2. It provides an opportunity for management to allocate resources to various activities after a thorough, cost-benefit analysis. 3. It ensures that the function undertaken are critical for the achievement of the objectives. 4. It provides a systematic approach for evaluation of different activities. 5. It helps in the identification of wasteful expenditure and then their elimination. It facilitates the close linkage of departmental budgets with corporate objectives. Difference between traditional budgeting and zero-based budgeting. Following are the points of difference between traditional budgeting and zero-based budgeting. 1. Traditional budgeting is accounting-oriented. Main stress happens to be on previous level of expenditure. Zero-based budgeting makes a decision-oriented approach. It is very rational in nature and requires all programs, old and new, to compete for scarce resources. 2. In traditional budgeting, first reference is made to past level of spending and then demand for inflation and new programs. In zero-based budgeting, management focuses attention to only on decision packages, which enjoy priority to others. 3. In tradition budgeting, some managers deliberately inflate their budget requests so that after the cuts they still get what they want. In zero-based budgeting, a rational analysis of budget proposals is attempted. The managers, who unnecessarily try to inflate the budget request, are likely to be caught and exposed. Management accords its approval only to a carefully devised result-oriented package. 4. Traditional budgeting is not as clear and as responsive as zero-based budgeting is. In traditional budgeting, it's for top management to decide why a particular amount should be spent on a particular decision unit. In zero-based budgeting, this responsibility is shifted from top management to the manager of decision unit. 5. Traditional budgeting makes a routine approach. Zero-based budgeting makes a very straightforward approach and immediately spotlights the decision packages enjoying priority over others. Limitations of zero-based budgeting. 1. The work involves in the creation of decision-making and their subsequent ranking has to be made on the basis of new data. This process is very tedious to management. 2. The activity selected for the purpose of ZBB are on the basis of the traditional functional departments. So the consideration scheme may not be implemented properly. Performance budgeting, PB. Performance budgeting provide a meaningful relationship between estimated inputs and expected outputs as an integral part of the budgeting system. Establishing a meaningful functional program and activity classification of government operations. Bring the system of accounting and financial management in accord with this classification. Evolving suitable norms, yardsticks, work units of performance and units costs, wherever possible under each program and activity for their reporting and evaluation. Traditional budgeting versus performance budgeting. 1. The traditional budgeting gives more emphasis on the financial aspect than the physical aspects or performance. PB aims at establishing a relationship between the inputs and the outputs. 2. Traditional budgets are generally prepared with the main basis towards the objects or items of expenditure, i.e. it highlights the items of expenditure, namely, salaries, stores and materials, rates, rents and taxes and so on. In the PB, emphasis is more on the functions of the organization, the programs to discharge these functions and the activities which will be involved in undertaking these programs. Budget ratio. These ratios provide information about the performance level. Capacity usage ratio. Standard capacity employed ratio. Level of activity ratio. Efficiency ratio. Calendar ratio. Efficiency ratio equals standard hours divided by actual hours multiplied by 100. Activity ratio equals standard hours divided by budgeted hours multiplied by 100. Calendar ratio equals available working days divided by budgeted working days multiplied by 100. Actual capacity usage ratio equals actual hours worked divided by maximum possible working in a period multiplied by 100. Standard capacity usage ratio equals budgeted hours divided by maximum possible hours in the budgeted period multiplied by 100. Actual usage of budgeted capacity ratio equals actual hours worked divided by budgeted hours multiplied by 100. Thank you.